right, we are live. Welcome everyone to another episode of Foliko Live. I think we've got a really exciting slate of topics to go through today. So now our show today is going to be really about biotech. Have we reached a bottom there? And we're going to bring you along with us as we explore this space. I think there's a lot of interesting stuff. In fact, it actually wasn't our original intention to talk biotech today, but if you recall in our episode yesterday, we were talking about healthcare and we did some sorting on that whole sector. And we realized at the top of pretty much every forecasting window, biotech is just popping in the healthcare sector. So if you're looking for strength in healthcare, which if you recall was a little bit of a mixed bag, biotech is an interesting place to look. So we're going to zoom in on that, but we're also going to explore what makes a biotech company successful in the stock market versus other industries, because it's actually quite unique. Sometimes you're looking at cash flow, sometimes you're looking at growth potential. This is really going to be a little bit of a different beast. So we're going to talk through that. But first, I think we've got something really exciting to talk about. So if you recall and go back, watch our show from this last Monday, we did an earnings roundup. Okay. And the big conclusion from our earnings roundup was going through the earnings reports for the week. Rite Aid was really an interesting company to look at this week. We're going to go through what our prediction was, how we arrived at that prediction, and what's been happening ever since then, and how we've been trading, because we have been trading on this information since Monday. So let's jump right into it. Tyler, you ready?
Yeah, absolutely. So, like we mentioned on Monday, we came out with a pretty non-consensus call on Rite Aid. We're looking for 40% upside over the next 12 weeks. That is now 30% upside over the next 11 weeks. The stock has moved from 618 on the open on Tuesday to about 707 here after that earnings beat. So that's a pretty nice move to start. We're well on our way, and we've reached our one end almost 4-week forecast in 3 days, which is pretty exciting, especially when you're long some calls. So how did we get here? How did we pick Rite Aid of all things? So I will start with over the weekend I get a list of the upcoming earnings reports from everybody. Then I go and I look in Foliko and I basically scan. I'll share my screen so we can kind of just show what I have going on over here.
And this is going to be the process, by the way, that we're going to be repeating every week. So every Monday is going to be our earnings roundup episode. That's where we're going to go through all the earnings releases for the week. We have some very special models that we have in order to predict what those earnings reports are going to be like. The accuracy on our models is getting pretty scary accurate. In our testing that we've been doing on a live basis and our trading that we've been doing for the past 3 or so months, we'll tell you a little bit about our successes there. And actually a few wrong calls as well. You're going to get both here, but by and large, this has been a very successful set of models. Every Monday, tune in. We're going to be going through these earnings reports. So hit that subscribe button, hit the bell so that you're notified whenever we're going live, so that you don't miss a second of our coverage and miss that trading opportunity before it hits. Go ahead, Tyler.
All right, so I'm gonna take you through it. So, like I mentioned, this is kind of the bottom of the order in terms of earnings. So we only had 3 or 4 names on our coverage list: Lenner, CarMax, FedEx, and we did a preview on Monday. We will preview all of these, but we really didn't have much anything exciting to say either way. But here we did. So I'll kind of start with the genesis of the first part of the screener. So we have found that the divergence between the orange line, which is our earnings power factor, and the gray line, which is price, has been significant going into earnings. So I want to reiterate, this is a one-factor model for effectively earnings weeks betting. If I could simplify it, this is what we're trying to do is systematize a way to trade earnings, and we are using Foliko to look for unexpected moves. We were able to accurately show that Netflix was going to go the wrong way. That earnings power had started to deteriorate going into earnings. And this was really the opposite here. Earnings power had bottomed sometime in March. and had really, done some work to get off the bottom here. Well, the stock just kind of muddled there. We've had many such setups actually this quarter, one being Kingsoft KC, that had some nice upside because the stock hadn't realized that basically the earnings, factor had turned until earnings itself is reported. That's basically what we see is 4 times a year, the price should revert towards earnings power is basically, how we think of it is once a quarter, those lines have to have a conversation and figure out where they need to be. So that's step one. So I see that's obviously very interesting. So then we go to step 2. We look at the forecast. 40% return in 12 weeks. That's a call. That's a view you want to put on. That's a view you get paid to put on. And if you're right, that's a view you'll get paid for.
And real quick, Tyler, I want to jump in on this because this is interesting. Look at that forecast and look how smooth it is. Look how smooth that upside is. Sometimes you'll get like a 40% upside call out like that on our forecast, but it'll be choppy, right? Like 4 weeks in, we're looking at down. 8 weeks later, we're looking at up. And that actually is an indicator of some volatility, maybe a little bit more risk. If we were to break this down to a Sharpe ratio on what our forecasts are going to do, you're looking at, even if you achieve that higher return, more volatility to your portfolio. But when you're seeing something smooth like this, that is absolutely a signal that there's something going on in this company.
Yes, and I think I said something on Monday to the effect of, we're putting our feet in the ground and we're making the call here. We're saying we agree with the 40% upside here. And yeah, I mean, one of the most important things, when I've been spending time with and trying to use Foliko to confirm trades, is the conviction, is to start to be able to distill. Okay, so Foliko thinks this. How sure? And so, it's things like this where, we have a nice line that just to me tells me that Foliko thinks this is just, grossly undervalued. We don't see, I mean, look at this. So we don't just give a prediction, we give a band. So our prediction is basically, what is in the middle. But if you look here, our band is between 30% and 50% of upside. So we see scenarios in which, it's up 50% in 3 months.
And by the way, just for everyone's knowledge, that's the 95% confidence interval. So when you have a lower band that is still not too much of a haircut, if it hits that lower band and you're still okay, but if it hits that upper band and life is just phenomenal, that's definitely a signal. And that lower band is higher than current prices, I believe, right?
Way higher. I mean, it's 30%. That would be like $1.50 higher from here after a 10% move.
And so, I mean, pretty much all alarms going off. Rite Aid was strong. So and Tyler, that's your process to then you send me some tickers at that point, right? You send some tickers to run through our next earnings power model, right?
Yes. So we will then, are you talking about specifically RAD?
Yeah. So I was thinking, let's talk through exactly what we do next to then make the call. So I'm gonna steal the screen share from you here. This is the output of. Then we take all this information, the health score data and the modeling data. And remember why we're talking about this. We want to get to further information, but the next time you're wondering, well, how do these guys make their earnings reports calls? Like, what is it that's going into this whole process? Because remember, every Monday we're coming out with new earnings report releases. That's our roundup. And so you're going to want to tune in. Again, make sure you hit that subscribe button so that you're getting all these insights straight to you. But this is what our model output looks like. And what I've done here is it's pretty straightforward. We're taking all of the data that we have available in Foliko that's available to all of our customers. And then I'm just layering, if you happen to know the data science piece of this, I'm layering on top some light gradient boosted machines. So that's a machine learning technique that you can use. It's open source, that model. So you're just throwing all the Foliko data into that model and you're able to come out with some outputs. There are a few tweaks that I make there to optimize it, but by and large, that's what you're looking at. I want you to be able to do these things yourself on your own machine. And we're going to have some master classes on how to do that. So you can start showing us your own models. But essentially what we come out with this, Now, this is a probability distribution function right here. So at the 50%, that's what we would call the expected value. All right. So our consensus view from our models is right here at the 0.5. And so for Rite Aid, that's what we were calling. But then if you look at the 0.4, 0.3, in other words, there's a 70% chance that it will be higher than this point, right? So that's how you think about that. There's a 70% chance that it will be lower than this point, right? So again, that's for PDFs, this is how you think about it. But at the end of the day, the 0.5, that's what we're calling. What's interesting about this look here is if you look at the upside over 0.5, you see a very gentle increasing curve, okay? Or a gentle increasing slope, right? If you go to the downside, you see massively increasing slope on the downside. And so what this is saying is it's going to be really hard, really hard for Rite Aid to be profitable in this quarter. Really hard. I mean, look at the how much in percentage you have to climb in order for Rite Aid to actually be profitable. So we're definitely calling a negative net margin here. But at the same time, there are scenarios that you could imagine a pretty down earnings per share. However, so we're calling 0.5 here. Tyler, what actually happened? Because earnings were released this morning, right? Just a couple hours ago.
Yes. And so what we had was negative 60 cents a share, which was better than the expected negative 70 cents a share. And then we had about 6 billion flat in revenues, which was considerably better than the 5.75 that the market consensus had for us there. So Foliko definitely beat the street on that one today.
So then Monday, I'm giving you this data. How did you actually put it into action? So what happened since then?
So there was a lot of ways to do this trade, because you could have just closed your eyes, clicked, buy, and just gotten long the stock, and you'd be very happy. We got a big move on the stock already, and we obviously think there's way more to go. But personally, one of the most useful ways I have found to trade Foliko is to use options on stocks that we think have basically a crazy large outsized move coming, 40% in the next 12 weeks. That was not even close to priced by the options. So you get the opportunity to make a bet that gives you some convexity in the upside, where you get paid some pretty good money to put this trade on. That's not what I did. You could have bought 7 strike calls for a very low premium, and that would have worked incredibly well. But what I prefer to do, especially as we test this and to take safer profile trades, I just bought the 1 week at the money call on Tuesday. At the money means is it's the closest option to whatever the spot price is. So when the stock opened at 618 on Tuesday, I bought the 6 strike call. I paid 60 cents for that, with the intention of holding it into earnings, because in my opinion, you don't get paid on earnings bets until the market delivers the event. It happens where the stock will run pre-earnings or fall pre-earnings, and you don't have to carry the risk into the event. But that's very rare, and in my opinion, you're lying to yourself if you're thinking, I'm putting on an earnings trade and not carrying through earnings. No, if you're going to do this and you're going to, use the health factor the one factor model like I am, it's pretty imperative you do it this way. But anyhow, so I bought the 6 strike call Monday, and was actually able to roll out of it. And by that, I mean, I sold the option I had, and for that, I was able to purchase next week's option at 7 instead of 6, and was able to take money out of the trade. So now I have basically a free option for next week. Effectively, I've already covered what I put out this week, and basically the profit from the trade is going to carry forward next week. So essentially, it's a riskless trade insofar as if the new option goes to 0, I'm flat for the position. I've used what I made on this week's option to pay for next week's option is effectively how we do that. And I'll go a little bit into that more when we look at biotech, because we actually have some pretty fun upside ones there as well.
And by the way, all right, again, I'm going to keep harping on this. Hit that subscribe button, because we are going to have Tyler going through a whole masterclass on how to think about these options trades, how to get started. You know, there's a ton of lingo here that goes into all this. It seems pretty complex, but once you start getting into it, that motion and that muscle develops, and you can just go and start increasing your returns, doing the roll-ups, making these transactions just like Tyler's describing right now. But look, Tyler, I think this was a big win. This is exciting. Every Monday, we're going to be trying to get our audience as much of these wins as we possibly can. So look, excellent stuff. We need to move on. In the next 10 minutes, I want to talk about biotech. So again, biotech coming up here. I want to talk about what an interesting sector this is. And to kick us off, I actually want to take a look at where we're at with the market in total. So, and actually, if you don't mind, Tyler, I'm going to take your screen down for just a second here as we go through this. So this is XBI, which is a biotech ETF. A group of very smart people have come together and said, if you're going to be measuring how biotech is doing, here's all the companies that are really a part of that. And then they make some weighted shares in that. So this represents a view of how biotech is doing. Now, take a look at where this is at. It's at 71.79 right now, right? If you look across time for this, the last time biotech was like really at this level was June 11th, 2017. And you know, discounting these sharp drop downs in 2018, of course, we had that big volatility spike there in 2018, and then 2020, of course, COVID is starting. But if you look back here, 2017, mid 2017 is really the last time that biotech was trading at this level. Now, you've got to ask yourself, in the past, since 2017, what is that, 5 years? In the past 5 years, are we at a different state of innovation for biotech than we were 5 years ago? And in my opinion, this is just my view, 2020 and going into COVID was really the kickoff for the age of biotech, in my view. I mean, we have Moderna coming out with some mRNA vaccines, just incredible science coming into bear and increasing public trust with this kind of therapeutic. If you recall, this was the first real big major commercial success of mRNA vaccines. You think they're just going to give up at that? You think they're just going to be like, oh, mRNA, remember that one time we pulled it off? That was great. No, there is an incredible slate of innovation coming out, and we're going to be seeing amazing things happening for healthcare in the next 5 to 7 years through biotech. Again, my opinion. So in my mind, having this selling at the same rate or same valuation as it was 5 years ago is a little bit ludicrous. But I want to go through and deep dive into how the biotech stocks actually appreciate in value. And I think one of the best ways to get a view of this is the number 7 performing stock of the 2010s. That is Regeneron. It is a biotech company, right? Let's take a quick look at Regeneron. So one nice thing about them, they actually have a whole timeline and history of their company on their website. And so this is really illustrative to see what was the big events happening in their company. So you can see they're just getting started. They're listed as a stock. They go their IPO for $91.6 million, raising that amount of capital in 1991. But 1992 is when they're doing their first big investigational drug. It was a neurotrophic factor, and they're beginning clinical development there. If we come back and we compare Regeneron and their stock prices in this time period, you can kind of see what's happening there. They're mostly flat. So they have their IPO at 17, mostly sitting flat. Things, got rough for them in 94, 95. However, once this neurotrophic, and I hope I'm saying that right. I am not a biotech expert by any means, but we're going to talk through this. 1992, phase 3 trials start, and this really is helping them out because this is going to be a big deal if they release the drug. So take a look at this. They're not being evaluated, or the valuation of their stock is not based on current sales or current revenue so much as it is that pipeline of drug development and how that's how that's performing in those clinical trials. So stage 3 being a big deal there. 1997, their phase 3 trial falls flat, doesn't work out. And you can see exactly what happens to their stock price right at that time. Boom, it absolutely dives. Look at this. They go from $3 up to, let's call it 18 because there's a spike, but really $18, 6x, 600% value return in 2 years. And then they plummet downward because of that innovation pipeline not being worth as much. So this is really what we see happening in biotech. And my big point is this. A lot of folks are going to say, okay, innovation, we're going to start seeing these drugs coming out in the next 5, 7, 10 years. I'll wait till then. As soon as they have this blockbuster drug come out or the innovation gets purchased by an innovation acquiree, which we're going to talk about later, right, Tyler? As soon as that happens, that's when I'm going to jump in. But I'm here to tell you that's when you're too late. All right, that's when the value has already been realized of that pipeline. So if you're going to make it with innovation in biotech, you've got to be able to understand the strengths of these companies in advance of things going well on their clinical pipeline. Okay, and that's really where we're making this call right now. So don't wait for that 5 to 7 years of innovation to strike in biotech. The time really to start seeing that bottom is around right now. So with that context, let's jump right in.
Yeah. So, just kind of off the top here, our data is suggestive that the XBI ETF itself is closer to a bottom than not. We'll go through some of the names, and we actually, Foliko tells an interesting story again today. And it actually is consistent with, what I kind of personally have believed in the last, 6 months to a year about the biotech sector. So let's jump in. So this is a sampling of biotech stocks. So we have, your high flyers, BIIB, Amgen, Regeneron. We have, some of your, let's call them, there's no nice way to say this. Like, these used to be great stocks, BHC and Teva. These used to be great companies. They've pretty much been sold, for, I'm not going to say almost a decade, but in the case of some of these, almost a decade. But it does tell an interesting story. So if you look at our forward returns for some of the larger, biotech names, Amgen, Regeneron, Moderna, all pretty flat forward returns.
Which makes sense though, right? Because Moderna and Regeneron have these massive valuations coming out of success on the COVID era. The COVID era is ending, so that means we need to let some air out of the tires, especially in a depressed stock market, right? So it's kind of the "what have you done for me lately" effect.
Yes, I think that's exactly right. I just think, that's just telling you, demand pulled forward because of COVID. So, this is where we pulled the demand from. So instead of rallying with the rest of the sector, maybe these will stink a little bit. But look at these forecasts: BHC, Teva, Denali, Takata, Z Labs. 20% upside. I know it's biotech, so it's a higher volatility sector, but that would be a pretty considerable move. And we have reason to believe that, these forecasts will realize or be close. But what I think is very interesting is kind of the delineation between the two. We have, AstraZeneca flat returns as well. We basically have the innovating companies who aren't large, who are potential buyout candidates. We have higher targets on, and we have lower targets on the acquirers, basically. When I think about, who's buying, Amgen's buying, Regeneron's buying, AstraZeneca's, a buyer of, companies and technologies like this. So I think, that kind of fits.
Meaning that they're not really themselves the big push on innovation themselves. As soon as the innovation is popping and as soon as it's really fitting that phase 3 success, that's when they're going to acquire the tech, right?
Right. They're just going to bolt it on. They're not going to, waste the time developing when, Takata, or, I'm not calling for Takata buyout. That was the first one I saw, or, any of these other names are now cheap. The balance sheet situation in biotech is pretty decent. There is cash to buy here. So I would expect, I actually do expect this. I do expect, considerably higher prices in some of these, the lesser, more innovative, less high quality, let's call them, not the biotech blue chips, while the biotech blue chips kind of go sideways. So, like I did yesterday, I took a look at some of the 3-month options pricing, and in both cases, we have significant upside, versus the market. So, if I end up triggering a trade there, I will, either I'll tweet it, I'll get back to you here, one or the other. But I do, at least step one is complete, and the model is, seeing that BXC and Teva are significantly cheap versus what we think the upside is.
Now, Tyler, can I take a second and push back on our own models, right? So a quick question is, we're seeing this as really kind of a show me market, right? You've got success, show me. Don't just give me a growth story and some nice slides. Do we need a market turnaround to allow for this growth in order to hit these targets, or is this something that could be accessible and possible within current market conditions?
I think it depends. I mean, I think if we're in an all-out liquidation, nothing survives, right? Like it's just a matter of did it stink worse than the rest of your stuff in the portfolio, right? Like you take those days, you take solace out of what stunk the least. But if we have some stability, yeah, I don't see any reason that biotech could at least outperform the general market. This is as a sector is taken a tattooing. So we're back to levels that start to get interesting. So I do think that we should see some good upside.
So in other words, if I understand it, this is a show me market, but it's already been shown. That's already priced in, and all we have left is room for good news and room for a time to get back on the train.
Yes, I mean, I can't. There are already, and I wish I had brought some names with me, but there are biotech shares that are trading below cash. And it's just, we have just a bunch of things like that when you start to stack them up, you realize, okay, risk reward is in my favor on the long side here. Especially because what the backdrop for the next 5 to 10 years looks like in terms of us trying to innovate health and all the different ways that it's entering our lives, whether UNH is partnering with Apple and putting everyone they insure on an Apple Watch, and just like we were talking about, any of this stuff. It's the new, we're moving towards that now. When you sign up with a company, you used to get a bunch of signing bonuses and stuff. Now it's all cool healthcare stuff. Do you want to go see these doctors? Do you want an ergonomic desk? Do you want just all the things for mental and physical health? So I do think this is a good level. I think we are calling for biotech to bottom before the market does. I think would be a safe assumption. But we would be focusing in these more specky names where we have some significant upside model, BHC and Teva being my two favorite, partially because they have the most liquid options. So that's probably what I would look at. So
Tyler, given that there is some red on the screen, as well as some great upside, but Regeneron and Moderna, is that to say we should be looking at individual tickers instead of an ETF, or would you still suggest an ETF approach?
So the XBI ETF specifically is it's equally weighted, and the weightings are very small. It's 1 or 2% a company at the most, when we're looking at the top before we start going down. So XBI has some good diversification where you catch kind of all the different pockets. I'm not a big diversification guy. That's only for if you're unsure. If you're sure, you're supposed to be anti-diversified. But this kind of diversification, though, where you capture everything you're kind of looking for, I think is interesting. But, for me, I would probably prefer to trade BHC or Teva, just, based on, we have a specific call on those two, as opposed to, putting into context. I think XBI is along, but we have a directly along, from our AI on these two names. So I'd prefer to trade those because that's where we've been most successful.
Great. All right, Tyler, I think we've got to cap off from there. I've got to make some trades. I just, full transparency, I am going to be adding in Teva as soon as the market opens for my own portfolio. And we're going to track that over the next 12 weeks. I'm excited about that trade, probably BHC as well. So when I'm sharing my Robinhood account in the future, you'll see those tickers in there, and we'll see how they perform. Also, every week, I want to make an announcement. We are going to be going through a report card. We're going to be actually cutting scenes from our weekly show where we're making predictions and forecasts, and then we're going to stack those forecasts up to what actually happened in reality. And we'll be able to give ourselves a score and show you exactly what's going on. Again, this whole program is about us talking about the things we know, talking through the things that we have confidence in, but we want you to be informed for when we're wrong, you should know, right? Rite Aid, we had a big win. Let's take a look for some of the things we missed. Fortunately, I guess, we said Sedgwick was at a bottom, could go higher. Yesterday, Sedgwick had an awesome day. So oil. We said oil was probably at a peak. Oil has tanked since then. Looks like our report card this week is really pretty fantastic, honestly. But we're gonna really dive deep and give you the real numbers. Make sure you're along with us. Again, hit that subscribe button so you can catch all the action as it happens. Tyler, my last thought of the day. 10 years ago, I was expecting self-driving cars, an Apple Watch teaming up with my insurance provider. I want them to drive me places without me steering. I don't want Apple to know if I'm tachycardic. So I'm not sure I'm excited about this. we noticed you're having a heart attack. Would you please watch this Domino's ad, and we'll call an ambulance like 30 seconds in, and you'll get a free ambulance ride. I don't think I'm in for that. But
no. Oh my God.
All right, everyone. Thanks for joining, and we'll catch you soon. Join us again on Monday for our live program. Again, Monday through Thursday, we're coming at you with Foliko Live. Thank you all.